Hi, Dari here from Sim Africa. Okay, today we're going to be talking about investment and portfolio risk. Your investment carries a level of risk, and of course, this in turn affects your portfolio. But every user should be able to know how to allocate their investments such that they can minimize their portfolio risk. However, there are different ways to invest. You could want to invest on your own, which will help you gain more returns and understanding of the markets. You could also want to give your funds to a manager. This, lower returns, but it's just giving it to the expert. So what is a portfolio? A portfolio is a collection of baskets of financial investments. So you have different classes of assets in your portfolio. Okay, so we're going to talk about these various assets today, assets under each financial investment. An investment is an asset or item purchased with the expectation to generate income or appreciate in value in the future. So if you buy something and then you expect that it will appreciate in future, then that is an investment. Okay, but every investment comes with its risk, and the knowledge of the risk of every investment you buy is very important, because it will also determine the kind of gains you will make when you invest in those kinds of assets or portfolio. Okay, the risk is a degree of uncertainty or potential financial loss inherent in an investment. Okay, whenever you buy an asset or you buy an investment, you are also buying its risk alongside. There is no way you will buy an asset for investment and then you are not buying its risk. Okay, so we are going to talk about these types of risks shortly. So you have the market risk, you have inflation risk, you have mortality risk, interest rate risk. Anything could happen to the interest rate. Liquidity risk, there could be a drop in liquidity. Inertial risk, the will to start. But this is not our focus today. We are focusing on the scale of these risks today. Okay, so when you are investing, you need to understand the investment approach and risk involved, because risk and reward are two sides of the same coin, and the scale different from a particular asset class to another asset class. Okay, so because we have scales for the low risk investment, the medium risk investment, and high risk investment, look at this as gauging the temperature of your investment. So for the low risk investment, there's perceived to be little or no chance of losing some or all of your money, because in this investment you're actually keeping your funds with big financial institutions, or even giving your money to the government. Lending to the government. Okay, the good book says you will lend to nations. Yeah, this is what it means in here. Okay, so but this majorly focuses on capital preservation, so you will get only a little rise or little capital gain in your investment. Sometimes this percentage gain you make on a low risk investment is lower than inflation at some point. So examples of this: high yield savings. Okay, you can have this with your bank or financial institution. Money market funds, okay, just like your mutual funds. You have treasury bills, lending to the government, getting paid up front, government bonds, corporate bonds, and money market accounts. All right, medium risk. Here is an investment where the investor is likely to accept significant risk in return for a potential gain over medium or long term. So you're looking at a potential gain over 3 years, 5 years, or 10 years. Yeah, but then you will have fluctuations in the value of your assets. Okay, so this is just for medium growth. You might not have all the 100x 200x kind of gains in here, but it's just for a medium growth. Okay, you are less exposed to market fluctuations, not as much as if you invest your money in high risk investments. So the fluctuations is less here, but of course there are also fluctuations in the medium term. Okay, so examples are the real estate, dividend paying stocks. In Nigeria, most times you don't have fluctuations in real estate value. ETFs, peer-to-peer lending, small businesses, and stocks, especially stocks of blue chip companies. High risk investment. This investment is aimed at generating exceptional return for investors. Most times people take some risk and say you cannot make money without risk, but most times they are not going for investments, they are going for scams. And I'm still going to talk about how to locate or identify a scam. All right, so you have your rate is always higher. Rate of return here is always higher than what you would have in inflation. Yeah, there will now be capital gains. There is also even a higher probability of loss of your capital in here. So that's why it is better to tread with caution and to learn your way through, okay, before you start investing, especially in high risk investment. Examples are cryptocurrency, currency trading, IPO, that's initial public offer. Imagine you invested in Tesla when Tesla launched at $17, venture capital, and also some stocks. Okay, yeah, so let's go to risk allocation. Here, balance is the rule of the game. If you want your risk to be moderate or limited, you need to balance it. You don't put your life savings in high risk investment. You put what you can lose, because that which you could lose can still give you 10, 20, 100, 200x within a period of years, within a couple of years. So it must not be something you want like right now. Okay, so you must balance it. Investors must always rebalance also their portfolio. So let's look at portfolio. How risky is your portfolio? You have the low risk portfolio, you have medium risk portfolio, and you have high risk portfolio. So here's how to allocate the assets or the investments that we have mentioned earlier on. When you're considering using the low risk portfolio, you have more of your money, more of your capital in low risk assets. And I tell people that the older you get, you begin to tilt towards the low risk portfolio. Okay, because you cannot absorb as much shock, and you don't want to put all your money in high risk investment at this time. So you have in the medium risk portfolio, you could balance everything or put more weight in the medium risk asset. The high risk portfolio, of course, has more weight in the higher risk asset. Now this is actually for younger people that can withstand this. So you can still do this because you can get up from a shock. All right, I hope this really helps you. Okay, I want to know which of this portfolio would you rather go with. Okay, so consider your age and then consider which one you would rather go in. The high risk portfolio will make more money for you, but of course balance is the rule of the game. Do not invest what you cannot lose. Okay, this is not a financial advice, but take time and study. Thank you. Dari signing out.